The tariff headaches begin again. A few hours after the Supreme Court struck down Trump's previous tariff authority under the International Emergency Economic Powers Act, or the EEPA. In response, Trump immediately invoked Section 122 of the Trade Act of 1974 to impose a temporary global tariff, 10%, then raised to 15%, for up to 150 days without congressional approval. Will Section 122 fail the same way as EEPA for tariffs? Section 122 has never been used to impose broad tariffs like this, and legal experts have already raised constitutional questions about it. Let us look at the second round of the tariff fight. Many U.S. businesses, especially importers and manufacturers facing higher costs, will challenge these tariffs. Their lawyers will tell them that they have a strong case. Why? Section 122 was designed to address balance of payments issues, a context that hasn't existed in decades and wasn't intended to authorize sweeping tariffs. The statute was used beyond what Congress intended. President Trump seems to treat the trade deficit as equivalent to the balance of payments. What then is the difference between a trade deficit versus balance of payments? These two terms are related, but they are not the same thing. Think of it like this. Trade deficit equals one part of the story. Balance of payments equals the whole financial picture. A trade deficit happens when a country imports more goods and services than it exports. Simply, exports minus imports equals trade balance. If the number is negative, it means that there is a trade deficit. If positive, it is a trade surplus. For example, if the United States buys $3 trillion of foreign goods, but sells $2.5 trillion of exports, it has a $500 billion trade deficit. The trade balance only includes physical goods, cars, oil, electronics, and services, tourism, software, consulting. By the way, President Trump skewed the trade balance equation by focusing only on physical goods, not services or tourism. Next, let us look at the balance of payments. It is a complete record of all financial transactions between a country and the rest of the world. It includes two major components and several subcomponents. The first major component is current account. It includes trade balance, exports and imports, investment income, dividends, interest, transfers, foreign aid, remittances. The next major component is the capital and financial account. It includes foreign investment, stock and bond purchases, real estate purchases, loans and banking flows. I repeat that the trade balance and deficit are only a part of the equation in the balance of payments. Do you know that the balance of payments always balances? If a country runs a trade deficit, it must finance it somehow. For example, if the U.S. imports more than it exports, foreigners might invest in U.S. assets such as in stocks and factories, buy U.S. Treasury bonds, purchase U.S. real estate. That inflow of money appears in the financial account, offsetting the trade deficit. So, trade deficit plus capital inflows equals zero, in accounting terms. That's why the overall balance of payments always balances. Let us review briefly. Trade balance and deficit is only one component of balance of trade. U.S. residents enjoy and spend their money on goods, and the rest of the world pours its earnings back into the U.S. The current U.S. administration treats the trade deficit and the balance of trade as the same thing. Guess what U.S. businesses will do next?